What's going on, everybody? TG here, back with another video, and we're going to be talking about AMC stock today because everyone, including their moms, have been talking about AMC stock and GameStop, and we have to address a couple things on this because the company did just report earnings, and the earnings were actually pretty solid. When you talk about revenue, obviously they're still losing a ton. Okay, they're still losing a net loss of 6.21 per share. That is huge. That's obviously never good for a company to lose that much, but revenue was up. Okay, revenue beat the estimates of 162.5 million when they were only estimating 142. So they did about 20 million more than expected, and companies obviously rose, stock rose because of that. But there are some underlying issues that we can just not talk about. The biggest one is their debt. Now, when you talk about a company's debt, it is very important to look at this stat because debt can destroy a company, and that's why a seller or an analyst came out with the sell price of 1 cent. 1 cent for AMC. Now, AMC is obviously trading about $10 right now and 28 cents, so obviously that is about a 99.99% decline. And they're essentially saying that the leverage that AMC has taken is going to screw them. They have about 8 times leverage with their debt, and they have a lot of interest that they have to pay off. They've already issued a lot of shares in the near future or in the near term that's happened this year. A lot actually. And at first the stock actually went up when they did this, which is kind of surprising because it's dilution. You would think the stock would go down, but it was in a kind of a crazy phase with the whole meme stock rising, and the stock actually went up. But the biggest problem right now is the interest that they're going to have to pay on these this money that they have loaned to them. So AMC obviously had to take out loans. Like they had to in order to survive. The company was losing so much every quarter. If we go here and look at some of these quarters, last quarter, 905 million. Quarter before that, 562 million. Quarter before that, 2.1 billion. Quarter before that, 13 million. And that was not even during the pandemic. So you're just seeing giant losses every single quarter, and you're talking about a company with a market cap of only 3.4 billion, and they're losing 900 million, 500 million, 2.1 billion. They're losing almost their entire market cap, and so obviously they took out an insane amount of loans, an insane debt with 8 times leverage. And those interests are going to hurt bad when they have to pay. In addition, the company cut back on capital expenditures during the pandemic, and it feels like maintenance capex is at least 200 million. So that's obviously another big issue, being that if it's really what it says, at least 200 million, that's a big issue. He goes on to say the end result is a company with 8 times leverage and no free cash flow. Obviously, free cash flow is huge for a company. That's cash flow that's coming in every single month. An example, Amazon Prime. People are, paying a subscription based every single month. That's free cash flow coming into the company that the company can then use to do things like pay off debt, pay dividends, different stuff like that. So the company has no free cash flow. He also wrote, if attendance fails to rebound as we expect, not to mention declines long term as release windows shrink and consumer behavior evolves. Basically, what he's talking about that is the rise of things like Netflix and Disney, because Disney and Netflix continue to increase their subscribers every single day. And Disney actually just hit Disney Plus subscribers just hit 100 million very recently, a couple days ago. 2 days ago, 100 million subscribers. So more people are switching over to the streaming service and less people are going out to the movies. Obviously, people are going to go to the movies when the pandemic ends. People want a sense of normality, coming back into the world. You want that. But if audience does not come back to the levels that they're expecting it to grow, and a lot of people are expecting, analysts are expecting it to decline. I personally think it's going to decline. I think that the way we are digitizing and, the stay-at-home economy, part of that is going to remain when we get out of this pandemic. People are going to want to stay at home. Why go to a movie and pay a ton of money for something and pay a ton of money for food when you could order it at home? You can have food delivered to you with things like Grubhub, DoorDash. These companies have really changed the way they do things. And because of that, it makes it so much more convenient to just stay at home and do something rather than go drive somewhere, risk getting sick, If people are still afraid about that, pay a bunch of extra money. It's just not worth it when you can have the convenience of ordering something at your home, something like Disney Plus or Netflix or Hulu or HBO. So much competition out there, and AMC is now evolving to that. Now, the short term is a lot different. Obviously, things can happen in the short term. The stock could spike back up to 19 like where it was. If you have one of these weird freak squeezes or, rallies from Wall Street bets. But, the reality is it has an insane debt level that they're never, never going to be able to pay off. It is essentially impossible for them to pay off this debt. And AMD has raised about 1.2 billion in capital since mid-December. But they still have over 5.7 billion in debt to pay off. Their company's not even worth that. They could sell their entire company and still be short on the debt. So obviously there's no possible way they're going to, somehow get rid of all their debt. So that means interest payments all the time, always keeping the company from really advancing at all. And that's obviously a huge, huge screaming issue for the company. So short term, obviously something could happen, something could change where, maybe the company rises back up to around 15 or so. But, when you have that much debt, it makes it almost impossible to leave. You are stuck. You are stuck in sand, and you might inch up a little bit, but in reality, you're always going to be stuck there. And eventually, when you're unable to fight anymore, you will sink. And I think that's exactly what's going to happen to AMC. I know a lot of you guys like it. I know a lot of you guys are fans of AMC stock, but you can't deny the reality of this. A company that is losing money, a company that is not evolving but staying the same while everything else evolves. Companies are being initiative and creating things like these streaming softwares like Disney Plus and Hulu and Netflix make it convenient for people. People don't want to go out to a movie theater and have to pay a ton of money to watch a movie when they can watch it at home for free. To compensate for this, AMC is going to have to raise prices of movies or raise prices of food. And again, another turnoff for people that want to eat this. Obviously, if you look at the stock 5 years ago, the stock in 2016 is a $35 stock. But I mean, even in like 2019, before this pandemic, it's only a $16, $15 stock. Even in June of 2019, before this pandemic even hit, this stock was a $7 stock. It's on the decline. The stock had fallen hard since the summer to the winter, right before the pandemic hit, 59%. Like, it's a declining business, and you have to look at these things because it's hard to just ignore the fact that the company is dying, and you can't deny just because they have an earnings quarter that they beat revenue by 20 million on, it doesn't take away from the fact that this company is swallowed by debt and either has to dilute a ton, which again going to cause the stock to go down because you're adding more shares into it, or they simply just sink. They file for bankruptcy. I don't know if bankruptcy is on the near term. I think that's going to be a while away, but I think in reality the fate of this company is pretty much done for. So my option strategy, if I'm going to do one, which I might have to open up, is selling leap naked calls on this. So essentially I would go here, I'd type in AMC, go over here. Obviously I'm going to do this on my other brokerage, E-Trade, when it transfers, but I would essentially sell call, sell the $20 call, not even $20 call. If you want, you can do a sell the $20 call. I'll do like a $15 call. Sell like 10 of them. Get paid, and I think it declines. I really do. I don't see this company rising above $15. So, you go ahead here and you put it in. You have, you sell it in my bad. You sell these calls, and then you collect a good premium, and you essentially say it's not going to be above 15 by next year. You make a ton of money. You make almost $6,000, but you obviously need 1,500 shares of it. So obviously you're going to need a little bit of a collateral. You're talking 15 times 100, 1,500 shares times 10, so you're going to need $15,000 to get $5,000. So I think it's a pretty good deal, and I'll probably end up doing that because I do think this company will go bankrupt, or at least will continue to crash. So that's just what I believe. I wanted to open it up to you guys about this because a lot of you guys are pouring your money into this company without really realizing the debt issues of the company and what could happen with this company. So Hope you guys enjoy. If you do, like and subscribe, and I'll talk to you guys in the next video. Take it easy, guys. Bye.